Indian budget terminology. On the 21st of September 2016, Government of India approved the merger of the railway budget with the Union Budget of India, and thus came to end a 92-year-old practice of separate rail and general budgets. The decision of merger was taken along with advancing the date of the Union Budget in the Parliament under the process of budgetary reforms taken up by the government. The rail budget was separated from the main budget, following recommendation of a panel headed by British railway economist William Mackworth in 1920-21. The rail budget has had a separate existence from the general budget since 1924, when the British spun it off for a better focus on India's most important infrastructure network.
Introduction. With the emergence of welfare state, governments have come to look after virtually every sphere of human life. They have to perform manifold functions, from maintaining law and order, protecting their territories, to implementation of plans for economic and social betterment. Besides, they provide a variety of social services like education, health, employment and housing to the people. Needless to say, government requires adequate resources to discharge these functions effectively. The necessary funds are mobilized from the country's resources by way of taxes, both direct and indirect, loans both long-term and short-term, to meet the governmental expenditure. It is not as if the government can tax, borrow and spend money the way it likes. Since there is a limit to the resources, the need for proper budgeting arises to allocate scarce resources to various governmental activities. Every item of expenditure has to be well thought out and total outlay worked out for a specific period. Prudent spending is essential for the stability of a government, and proper earnings are a prerequisite to wise spending. Hence, planned expenditure and accurate foresight of earnings are sine qua non of sound governmental finance. India has parliamentary system of government based on Westminster model. The Constitution has, therefore, vested the power over the purse in the hands of chosen representatives of the people, thus sanctifying the principle no taxation without representation. Preparation of budget for the approval of the legislature is a constitutional obligation of the government both at the centre and the state levels. Legislative prerogative over taxation, legislative control over expenditure and executive initiative in financial matters are some of the fundamental principles of the system of parliamentary financial control. There are specific provisions in the Constitution of India incorporating these tenets. For example, Article 265 provides that no tax shall be levied or collected except by authority of law. No expenditure can be incurred except with the authorization of the legislature, Article 266, and President shall, in respect of every financial year, cause to be laid before Parliament, Annual Financial Statement, Article 112. These provisions of our Constitution make the government accountable to Parliament. Annual Financial Statement. Annual Financial Statement, the document as provided under Article 112, shows estimated receipts and expenditure of the Government of India. The receipts and disbursements are shown under the three parts in which government accounts are kept, namely 1. Consolidated Fund, 2. Contingency Fund and 3. Public Account. Consolidated Fund of India. The existence of the Consolidated Fund of India flows from Article 266 of the Constitution. all revenues received by government, loans raised by it, and also its receipts from recoveries of loans granted by it form the consolidated fund. All expenditure of government is incurred from the Consolidated Fund of India, and no amount can be drawn from the Consolidated Fund without authorization from Parliament. Contingency Fund of India. Article 267 of the Constitution authorizes the Contingency Fund of India, which is an imprest placed at the disposal of the President of India, to facilitate government to meet urgent unforeseen expenditure pending authorization from Parliament. Parliamentary approval for such unforeseen expenditure is obtained post facto, and an equivalent amount is drawn from the Consolidated Fund to recoup the Contingency Fund. The corpus of the Contingency Fund as authorized by Parliament presently stands at ₹500 crore. Public account. Monies held by government in trust, as in the case of provident funds, small savings collections, income of government set apart for expenditure on specific objects like road development, primary education, reserve, special funds etc. are kept in the public account. Public account funds do not belong to government and have to be finally paid back to the persons and authorities who deposited them. Parliamentary authorization for such payments is, therefore, not required, except where amounts are withdrawn from the Consolidated Fund with the approval of Parliament and kept in the public account for expenditure on specific objects. Revenue budget and capital budget. Under the Constitution, annual financial statement distinguishes expenditure on revenue account from other expenditure. Government budget, therefore, comprises revenue budget and capital budget. Revenue budget. Revenue budget consists of the revenue receipts of government, tax revenues and other revenues, and the expenditure met from these revenues. Tax revenues comprise proceeds of taxes and other duties levied by the Union. Other receipts of government mainly consist of interest and dividend on investments made by government, fees, and other receipts for services rendered by government. Revenue expenditure is for the normal running of government departments and various services, interest payments on debt, subsidies, etc. Broadly, the expenditure which does not result in creation of assets for Government of India is treated as revenue expenditure. All grants given to state government, union territories and other parties are also treated as revenue expenditure, even though some of the grants may be used for creation of assets. Capital budget. Capital budget consists capital receipts and capital payments. The capital receipts are loans raised by government from public called market loans, borrowings by government from Reserve Bank and other parties through sale of treasury bills, loans received from foreign governments and bodies, disinvestment receipts and recoveries of loans from state and union territory governments and other parties. Capital payments consist of capital expenditure on acquisition of assets like land, buildings, machinery, equipment, as also investments in shares, etc., and loans and advances granted by central government to state and union territory governments, government companies, corporations and other parties.
Article 113 of the Constitution mandates that the estimates of expenditure from the Consolidated Fund of India included in the annual financial statement and required to be voted by the Lok Sabha are submitted in the form of demands for grants. Generally, one demand for grant is presented in respect of each ministry or department. Each demand first gives the totals of voted and charged expenditure as also the revenue and capital expenditure included in the demand separately. Each demand normally includes the total provisions required for a service, that is, provisions on account of revenue expenditure, capital expenditure, grants to state and union territory governments and also loans and advances relating to the service.
Cut motions. Motions for reduction to various demands for grants are made in the form of cut motions seeking to reduce the sums sought by government on grounds of economy or difference of opinion on matters of policy or just in order to voice a grievance. That the amount of the demand be reduced to 1 rupee representing disapproval of the policy underlying the demand. Such a motion shall be known as disapproval of policy cut. B. That the amount of the demand be reduced by a specified amount representing the economy that can be affected. Such specified amount may be either a lump sum reduction in the demand or omission or reduction of an item in the demand. The motion shall be known as economy cut. C. That the amount of the demand be reduced by 100 rupees in order to ventilate a specific grievance which is within the sphere of the responsibility of the Government of India. Such a motion shall be known as token cut. Appropriation Bill. Under Article 114(3) of the Constitution, no amount can be withdrawn from the Consolidated Fund without the enactment of such a law by Parliament. After the demands for grants are voted by the Lok Sabha, Parliament's approval to the withdrawal from the Consolidated Fund of the amount so voted and of the amount required to meet the expenditure charged on the Consolidated Fund is sought through the Appropriation Bill. The whole process beginning with the presentation of the budget and ending with discussions and voting on the demands for grants requires sufficiently long time. The Lok Sabha is, therefore, empowered by the Constitution to make any grant in advance, in respect of the estimated expenditure for a part of the financial year pending completion of procedure for the voting of the demands. Vote on account. Since Parliament is not able to vote the entire budget before the commencement of the new financial year, the necessity to keep enough finance at the disposal of government in order to allow it to run the administration of the country remains. A special provision is, therefore, made for vote on account by which government obtains the vote of Parliament for a sum sufficient to incur expenditure on various items for a part of the year. Normally, the vote on account is taken for 2 months only. But during election year or when it is anticipated that the main demands and appropriation bill will take longer time than 2 months, the vote on account may be for a period exceeding 2 months. Vote on account is obtained from Parliament through an appropriation vote on account, a bill. Finance Bill. The time of presentation of the annual financial statement before Parliament, a finance bill is also presented in fulfilment of the requirement of Article 110(1) of the Constitution, detailing the imposition, abolition, remission, alteration or regulation of taxes proposed in the budget. A finance bill is a money bill as defined in Article 110 of the Constitution. The finance bill seeking to give effect to the government's taxation proposals, which is introduced in Lok Sabha immediately after the presentation of the general budget, is taken up for consideration and passing after the appropriation bill is passed. However, certain provisions in the bill relating to levy and collection of fresh duties or variations in the existing duties come into effect immediately on the expiry of the day on which the bill is introduced by virtue of a declaration under the Provisional Collection of Taxes Act. Parliament has to pass the Finance Bill within 75 days of its introduction. Money bill is distinguished from financial bill. Whereas a money bill deals solely with matters specified in Article 110(1) of the Constitution, a financial bill does not exclusively deal with all or any of the matters specified in the said article, that is to say, it contains some other provisions also. Financial bills can be divided into two categories. In the first category are bills which contain provisions attracting Article 110(1) to F of the Constitution. They are categorized as financial bills under Article 117(1) of the Constitution. Like money bills, they can be introduced only in Lok Sabha on the recommendation of the President. However, other restrictions in regard to money bills do not apply to this category of bills. Financial bill under Article 117(1) of the Constitution can be referred to a joint committee of the Houses. In the second category are those bills which contain provisions which would on enactment involve expenditure from the Consolidated Fund of India. Such bills are categorized as financial bills under Article 117(3) of the Constitution. Such bills can be introduced in either House of Parliament. However, recommendation of the President is essential for consideration of these bills by either House, and unless such recommendation is received, neither House can pass the bill. Fiscal Responsibility and Budget Management Act, 2003. To attain fiscal sustainability, the central government and all state governments have adopted a rule-based fiscal framework through the enactment of Fiscal Responsibility and Budget Management Acts. The acts provide targets to ensure that government finances are managed with a view to achieve equitable and stable growth. The 13th Finance Commission had recommended a roadmap for fiscal correction and consolidation in the medium term. Macroeconomic Framework Statement. Macroeconomic Framework Statement, presented to Parliament under Section 3(5) of the Fiscal Responsibility and Budget Management Act 2003, and the rules made thereunder, contains an assessment of the growth prospects of the economy with specific underlying assumptions. It contains assessment regarding the GDP growth rate, fiscal balance of the central government and the external sector balance of the economy. Fiscal Policy Strategy Statement outlines the strategic priorities of government in the fiscal area for the ensuing financial year relating to taxation, expenditure, lending and investments, administered pricing, borrowings and guarantees. Medium-term Fiscal Policy Statement presented to Parliament under Section 3(2) of the Fiscal Responsibility and Budget Management Act 2003, sets out 3-year rolling targets for 4 specific fiscal indicators in relation to GDP at market prices, namely 1. Revenue deficit, 2. Fiscal deficit, 3. Tax to GDP ratio, and 4. Total outstanding debt at the end of the year. Outcome budget. with effect from financial year 2007 to 08, the performance budget and the outcome budget hitherto presented to Parliament separately by ministries, departments, are merged and presented as a single document titled Outcome Budget by each ministry, department. Outcome Budget contains a brief introductory note on the organization and function of the ministry, department, list of major programs, schemes implemented by the ministry, department, its mandate, goal and policy framework, budget estimates, scheme-wise analysis of fiscal performance and linkage between financial outlays and outcome, review covering overall trends in expenditure with regard to budget estimates. Approval of budget in the Parliament. The budget is discussed in two stages in Lok Sabha. First, there is the general discussion on the budget as a whole. This lasts for about 4 to 5 days. Only the broad outlines of the budget and the principles and policies underlying it are discussed at this stage. Consideration of the demands by standing committees of Parliament. After the first stage of general discussion on both railway as well as general budget is over, the House is adjourned for a fixed period. During this period, the demands for grants of various ministries, departments including railways are considered by concerned standing committees, Rule 331G. These committees are required to make their reports to the House within specified period without asking for more time.
Goods and Services Tax. The Constitution defines goods and services tax means any tax on supply of goods, or services or both except taxes on the supply of the alcoholic liquor for human consumption. Goods means every kind of movable property other than money and securities but includes actionable claim, growing crops, grass and things attached to or forming part of the land which are agreed to be severed before supply or under a contract of supply. Services means anything other than goods, money and securities but includes activities relating to the use of money or its conversion by cash or by any other mode, from one form, currency or denomination, to another form, currency or denomination for which a separate consideration is charged. Fiscal deficit. When the government's non-borrowed receipts fall short of its entire expenditure, it has to borrow money from the public to meet the shortfall. The excess of total expenditure over total non-borrowed receipts is called the fiscal deficit. Revenue deficit. The difference between revenue expenditure and revenue receipt is known as revenue deficit. It shows the shortfall of government's current receipts over current expenditure. Primary deficit. The primary deficit is the fiscal deficit minus interest payments. It tells how much of the government's borrowings are going towards meeting expenses other than interest payments. Excess grants. If the total expenditure under a grant exceeds the provision allowed through its original grant and supplementary grant, then the excess requires regularization by obtaining the excess grant from the Parliament under Article 115 of the Constitution of India. It will have to go through the whole process as in the case of the annual budget, that is through presentation of demands for grants and passing of appropriation bills. Disinvestment. By disinvestment we mean the sale of shares of public sector undertakings by the government. The shares of government companies held by the government are earning assets at the disposal of the government. If these shares are sold to get cash, then earning assets are converted into cash, so it is referred to as disinvestment. Guillotine. Parliament, unfortunately, has very limited time for scrutinizing the expenditure demands of all the ministries. So, once the prescribed period for the discussion on demands for grants is over, the Speaker of Lok Sabha puts all the outstanding demands for grants, whether discussed or not, to the vote of the House. This process is popularly known as guillotine.